Hello everyone. So in this session we are going to discuss about planning your tax strategy. So in life there are two certainties, death and taxes. It is said by someone and it's very interesting. Money that you provide to government. So it forms a major proportion of government income. And why does government need this income? So government need this income to provide us services like defense, services like medical, services like social security. Some part of your income or your earnings and provide these services on behalf of that. So about one third of each dollar that you earn goes to pay taxes. So it is much more than that. So there is a Canadian school of study that publishes its reports each year. So currently it states the income that you earn till June 6th goes towards all kinds of taxes. So it includes income tax, wealth tax, property tax, sales tax, etc. But the income that you generate from 1st of January to 6th of June each year goes towards taxes. So taxes are very important because if this amount of income you are providing to the government, it is important to plan that taxes. So an effective tax strategy is vital for successful financial planning. So, what are you expected? You are expected to have familiarity with tax rules and regulations, which can help you to maximize after tax cash flows and your net worth. So you have to plan your taxes so that maximum amount of money you retain, and you have to plan your taxes so that the net worth that you have, the assets that you have, you pay the least amount of taxes legally possible. To help you cope up with many types of taxes, you should know your current tax laws as they affect you. And it is legally important to know current tax laws. So if you make any mistakes while filing your taxes, you are responsible. Even if you take services of another person to do your taxes, he is not liable. You would be liable if there is any misrepresentation. So you should be aware of the current tax laws. Make employment, purchase, and investment decisions that leave you with greatest after tax cash flows and net worth. So, whenever you invest, you have to consider what is the tax implication of that investment. So, if there is an investment that is going to grow tax free, but it is going to give 9% return, and there is an investment that is taxable, but it is going to give you 10% return. Now, if you don't consider taxes, you would go with a 10% return investment. But if you consider after tax cash flows, and let's say the taxation rate is around 50%, then you would go with a 9% cash flow. So it is important to consider after tax cash flows while you make decisions. And you have to maintain complete tax records. So it is mandatory legally to maintain tax records for 3 years, because audit can go back to 3 years, and in certain cases 6 years. So it is always prudent to have all your tax records up to 6 years. Now, what types of taxes do we pay? So there are taxes on purchases, sales, and excise tax. So there are two level of taxation in Canada. One is the federal level of sales and excise duties, as well as there is provincial level. Now, except Alberta, most of the provinces charge provincial taxes also. But in Alberta, we'd only have federal taxes. Then there are taxes on properties, so real estate tax and personal property tax. So whatever your appraised value of house or your assets, you have to pay tax on it. So real estate tax is done on house. So if you have a house worth of $1 million, then you pay tax on $1 million, property tax on $1 million. Same way, personal property tax is implemented on yacht, vacation places, then scooters, then your car, etc. So any other asset that you have along with real estate means there can be a personal property tax on it. Now there is taxes on wealth also. So estate tax is when you transfer your property to your heirs, when you bequeath your property to your nominees, that is when estate tax comes. So estate tax is specifically when a person dies. So when a person dies, his last income tax return will be filed, that is called as terminal income tax return. And in that terminal income tax return, whatever assets he is passing, either he would be taxed or his nominees would be taxed. So estate taxes are implemented when there is inheritance of property or inheritance of any asset. Capital gain tax or losses are there when your net worth increases. So if I buy a share of Apple at $10, if I had bought a share of Apple in $10 when Apple was launched, means iPhone was launched in 2007, and in 2017 or 2007 2008, and in 2017 2018 I sold that Apple share for $100. So I bought it at $10 and I have sold it at $100. So difference between these two, that is $90, is my gain. So I bought at 100, I bought at 10, I sold at 100. So difference is my gain. This gain is called as capital gain because capital appreciation has happened. Okay. On this $90, I would be taxed. Current capital gain taxes are 50%. So 50% of this difference would be taxed. So entire $90 that I have gained will not be taxed. 50% of that, that is $45, will be taxed at whatever appropriate tax rate. Okay. Same way, if losses are there, you cannot get a refund on capital gain loss, but you can adjust those losses with your other capital gains. So if I have made money on Apple but I have lost money on, let's say, Tesla, so the amount of money that I have lost on Tesla, I can adjust that with amount of money that I have gained in Apple. And finally, the important part, they also tax your earnings. So whatever income you're getting from your business, from your profession, or from your salary is taxed. So filing your federal and provincial income taxes, first thing, determine whether you're required to file a return. Now if you don't have an income, you don't have to file your return, but if you have income, you have to file income tax return. But it is a good idea to file income tax returns even if you don't have any income. The reason is, if you are not earning, government gives a rebate of GST and QST, the indirect sales tax, sales means indirect taxes that you have paid. You get a rebate of that. You get those that amount of money back. Point number one. Point number two, there are certain deductions. There are certain um, investment instruments like tax-free savings account and RRSP, means registered retirement savings plans, etc. So if you don't file these returns, these deductions are not given to you. Example, there is a tax-free savings account deduction of $5,500, and if you don't take that deduction this year, that deduction carry forwards to the next year. So even if I have not earned anything, but if I still file my return in 2017, I get a tax-free savings account deduction of 5,500. This deduction I can carry forward to next year, and next year when I have my income, I will have a deduction of $11,000 instead of $5,500. So it is important to file income tax returns even if you don't have an income. So then you have to decide which form best serves your need. So which form do you file it in? We'll discuss it in future. Are you required to submit additional schedules or supplementary forms? So mostly if you don't have any business income, you just have to submit the T4 form. But if you have business income, then you have to submit some additional forms also. Who must file? All residents of Canada must file a federal income tax return for any year in which they have a balance of tax owing. So, what is a resident? Resident is not dependent on your um, citizenship status. So, you may be an American citizen or you may be a Chinese citizen working in Canada, but still you have to file income tax return if you have stayed in Canada more than 183 days. So, a resident is considered to be anyone living in Canada, but also includes non Canadians who are present 183 days in a year in Canada. Canadian residents are taxed on their worldwide income. This is important. So, if you are a Canadian resident, but for 3 months you went to China to work and you come back, so whatever income you have earned in China is also taxed. Now, there are certain double taxation treaties that Canada has signed. So, if you have already paid tax in China, then that amount of tax can be considered as tax paid in Canada. So you pay taxes only on the difference. So let's say the taxation rate in some country that has double taxation treaty with Canada. Let's say an example in India. So if India has a taxation rate of 30%, but Canada has a taxation rate of 40%. So the 30% tax that you paid while you worked in India is taken, it's considered as a credit for Canadian taxation. So you only pay taxes on the difference. And this happens only when there is a double taxation treaty within those countries. Otherwise, you pay tax in India as well as you pay tax in Canada too on the full amount. But if double taxation treaty is there, you pay taxes only on the difference. Now, what is taxable income? Taxable income is the net amount of income after allowable deductions on which income taxes is computed. So, how does it work? So I'll brief you, then we'll go back to the steps. So you have to first calculate total income. Total income is all your income put together. So it includes employment income, business income, investment income, capital gains, and all other forms of income like lottery winnings, etc. So this is your total income, right? From this total income you deduct certain deductions. Now there are certain incomes you don't have to report and there are no taxes on it, but still means for the time being all income you report as total income. From this total income you deduct certain deductions. So there are government approved deductions that you can take if you have convince if you have spent on those deductions. So you subtract those deductions, then you get equity, then you get net income. From this net income you deduct other deductions as well as you subtract the losses that you have carried over from previous year. For example, capital gain losses or etc that you have carried forward from previous years, you can deduct those losses, as well as there are certain other deductions. From that you get taxable income. On this taxable income you calculate federal taxes and then you take tax credits, then you add provincial taxes, and that gives you total tax credit. So how do you do it? Step 1, calculate your total income. Step 2, reduce deductions. Step 3, that is your net income, adjust losses, right? Subtract other deductions too. Then whatever income is there, that is your taxable income. On that taxable income calculate federal taxes. From this federal taxes take some tax credits, okay, and finally adjust means add the provincial taxes, and those are your that is your total tax due. Now, in this discussion, we have talked about two things, deductions and credits. So, what is a deduction and what is a credit? Now, deduction reduces your income, credit reduces your tax. So, I'll give you an example. So, registered retirement savings plan is a deduction. So, amount you spend towards registered retirement savings plan, amount you invest in RRSP is taken as deduction. So, if I have income of $20,000 and let's say for the time being I spent $500 on RRSP. I invested $500 in RRSP. What happens? My taxable income will now be $20,000 minus 500, that is $19,500. So deduction of $500 reduced my taxable income. Okay. Now tax credit doesn't do that. So in case of tax credit, what happens? So let's say because of my because I'm studying in a government recognized university and I get certain tax credit. So my fees per year were $30,000 and I get 15% tax credit on that. So my tax credit is $4,500. Now how does it work? So let's say my income is $80,000 and after taking all deductions, I was paying a tax of $20,000. Now because I have spent on education, that is $30,000 fee, I am getting a tax credit of 4,500. Now this 4,500 doesn't reduce my income. It reduces my tax directly. So my tax was $20,000, but because of this $4,500 credit, I reduce my tax to 15,500. So this distinction is important. Deductions reduce your taxable income, credits reduce your tax directly. Okay, so we'll go through the steps. So step 1 of filing your returns is determine total income. Total income consists of 5 major components. Employment income means your work, your job. Net business income, net is business income after considering all the cost for running the business. Okay, for example, if I am running an restaurant, I can deduct all my cost that are required to run that restaurant from my income. So let's say my yearly annual income is $1 million, but I'm spending $500,000 on salaries of my employees, on on food, on raw material, etc. So I can deduct this section of cost from my total income to get my net business income. So business income is adjusted by cost. Then there is investment income, that is you get it from your stocks, bonds, etc. Dividends and interest form a major form of investment income. Then you have taxable capital gains and you have other income like retirement income, old age security, Canada pension plan, employment insurance payments, etc. So this constitutes all your total income. So from this total income, you calculate net income. So net income is total income reduced by certain deductions. So deductions are contribution to RRSP, RRP and IPPs. So registered retirement savings plan, registered retirement plans and individual pension plans. So these are the three, these are the abbreviations for this. So basically you have to remember, if you're contributing to any type of pension, registered retirement savings plan, registered retirement plans or IIPs, you can take deductions for that. Now they have a limit to these deductions also. So if you're having a salary of 100,000 and if you contribute 100,000, it doesn't mean that your taxable income is zero. there are certain upper limits to these deductions, which we'll discuss in future slides. Then union and professional dues. So if you're part of any union, an amount of fees that you pay to union are considered as deduction here. Then professional dues are if you are a CPA or if you are an CFA. So whatever fees that you pay to keep that professional designations. For example, each year if you are a CPA, you have to pay fees to the CPA association. Or if you are a CFA, each year you have to pay fees for the CFA towards the CFA institute. So that fees you can consider as a deduction. Now, important point to note here is even if you're not using your designation in your current role, still you can claim deduction. So if I'm a CPA but I'm working in marketing and sales, but I still continue to pay my professional dues and maintain that CPA designation, still I am able to take deductions for those fees. Childcare expenses. So this is means if you are spending on childcare, disability support deductions, moving expenses. So if you're moving for employment, so I'll give you my case. I have moved twice in this country. So first time I moved from Ontario to BC and then from BC to Alberta. So when I moved from Ontario to BC, I took deduction of the moving expenses that I incurred in that year. Okay. And when I moved from BC to Alberta, again I took deduction of moving expenses. So if you're moving because of work, then you can take deductions. There are two things you have to consider. First rule, wherever you are moving, it should be within 45 kilometers of your workplace. So if I am moving from BC to Alberta to work in Alberta, in Calgary and in SAIT, so my stay should be within 45 kilometers of SAIT. Second rule, if your employer reimburses moving expenses, then you are not allowed to claim any deduction. Other deductions are business investment loss, interest paid on loans, specific loans like education loans, employment expenses, etc. You can take deductions of that. Employment expenses means, let's say you have a sales and marketing job and your employer is not reimbursing you for the amount of travel you incur. So you are spending out of your pocket. Your employer is not reimbursing your travel. So in that case, whatever you are spending on travel, you can take a deduction of that. Okay, but there are certain forms you have to get it signed from your employer to do that. After calculating net income, you calculate taxable income. So these are basic deductions. There are some additional deductions that we generally consider. So you adjust the net income by two things: additional deductions and losses carry forward from prior years. So security option deductions. So if you are an employer, if you are an executive in a company, let's say I am into management, top management of a company, my pay includes salary as well as some stock options. So the stock options I am getting from my company form a part of my income, but there are certain deductions that are available on these stock options. So I can take deductions that are available. Then capital gain deductions I can get, net capital loss of prior years I can deduct, and other deductions I can consider. Okay. On this taxable income, you calculate federal taxes. From this federal taxes, you adjust for tax credit, and that gives you amount of tax you have to pay or amount of tax refund that you are going to get. Income tax fundamentals. So you have to keep these things. So tax form and tax filing information. So you need to B means this information should be stored with you. Current tax form, reference books on current taxes because laws are changing and you are expected to be aware of it. Social insurance number, company copies of federal tax return from previous year, you have to maintain that. T4 forms are forms that you get from employers. So if I'm working with state, I get T4 forms from state. So you have to submit T4 forms while submitting your tax returns. So you have to maintain those T4 forms. T4A forms for reporting pension income, T5 forms for reporting dividends. So T5 forms are given by banks and investment firms. So basically, if you are an employed person, you get two kinds of forms. One, you get T4 forms from the employer. It happens, means they generally provide it in Jan and Feb. Then you get T5 forms from your bank, from your investment firm, that shows you your investment income. T5 forms for self employment, royalty income. So if you're self employed, you again need T5 forms. Then you have to record all your expenses, receipts or medical, dependent care, charitable donations, etc. You have to maintain. So we have discussed this. So once you have your taxable income, you calculate the total tax that you own. So taxable income is the basis for computing your income tax owing. Tax rates and tax credits are used to compute tax payable. Now there are two formulas that you have to remember. One is marginal tax rate. It is the tax paid on the next dollar of taxable income. It is the tax paid on the next dollar of taxable income. For example, there are tax brackets and I am falling in 20% tax bracket right now. So every additional dollar that I am earning is currently taxed at 20%. But let's say I am on the threshold of my tax bracket. I am in the tax bracket, means I am on the threshold of it. So for example, let's say there is a 20% tax bracket between incomes of 50,000 to 90,000, and any income above 90,000 is taxed at 30%, and I am currently at $89,000. And if I get additional $10, right, from my employer as bonus, that $10 will not be taxed at 20%, but it will be taxed at 30% because I'm changing my bracket. So marginal tax rate is the rate at which taxation happens for the additional amount of dollar earned. An average tax rate is simply amount of tax you pay divided by total income. Okay, amount of tax you pay divided by total income. So I'll show that to you on Excel so that it becomes more clear. So this is an Excel sheet. I'm giving you an example of marginal tax and tax. So let's say the bracket is 0 to, I'm just giving you example, this may not be the right brackets. 0 to 40,000 there is 10% tax. 40,000 to 90,000 is 20%, and 90,000 plus, so let's make it cohesive. So 4,001 to 90,000 and 90,001 plus is 30%. So these are the simple brackets that are there. Okay, so any income between 0 to 40,000 is taxed at 10%. 40,001 to 90,000 is taxed at 20%, and 90,001 plus income is taxed at 30%. So these are the tax rate. Now if my income is 45,000, so what will be my marginal tax rate and what will be my average tax rate? So how do you calculate that? Now for marginal tax rate, if I get additional $1 of income, which bracket will this $1 fall in? So this $1 will fall in the middle bracket, because this $1 doesn't lead my income to grow above 90,000. So it will still be taxed at 20%. So my marginal tax rate is 20%. Okay. Now what is my average tax rate? I have an income of 45,000. So what will be my tax payable? So for average tax rate, you have to first calculate tax payable. So my tax payable will be 0 to 40,000, 10% tax. So I have an income of 40,000 that taxed at 10%. So that is $4,000 in the first bracket, plus my income is not ending at 40,000. I have additional $5,000 more of income, which is taxed now at 20%. So start from the lowest bracket and go further. So my income was crossing the first bracket, so I have to pay $4,000 as tax. It is coming in second bracket, so I have to pay remaining amount that is left after the first bracket as tax. So it will be 5,000 multiplied by 20%, that is 1,000. So addition will be $5,000. So my average tax rate will be tax payable divided by my income. So my average tax rate is 11%. So for MTR, consider that you are getting additional $1 and how much tax you would pay. That is how to solve it. For ATR, average tax rate, calculate the amount of tax you are paying on your current salary and divide it by your tax income. Okay, so I'll again pause the video and we'll. Okay, so these are the federal tax brackets for 2017. So 0 to 55,282, 15% tax rate, 55,282 onwards to 90,563, 20.5% tax rate, 90,563 to 140,388, 26% tax rate, and 140,388 and above, 29% tax rate. So they have shown how in Alberta how it works. So first 45,282 you pay 25. So it's inclusive of, this was federal tax rates, but there are provincial taxes also. So if you consider provincial and federal both, so this is the effective taxation that happens. If you're earning less than 45,282, you pay 25% tax. If you are earning more than 150,000 to 200, you pay 45 or 42%. And the highest tax rate is on income. If you are earning more than 300,000, then you pay 48% tax rates. So once you have that, you calculate net federal tax. From that net federal tax, you adjust for tax credit. So tax credit is an amount subtracted directly from amount of tax owed. There are two types of tax credit: non-refundable tax credit and refundable tax credit. The important point to note: non-refundable tax credit doesn't make your taxes negative. They can only make your taxes zero. For example, if uh, I have to pay tax of $5,000 and I have a non-refundable tax credit of $6,000, so that will not generate in $1,000 of tax credit or tax refund from the government. My taxes will can only go to zero. they cannot go to negative and government will not pay me. Refundable tax credit can make your taxes negative so that you can get a tax refund. So if example, in this our same example, if I have $5,000 of tax and if I have a refundable tax credit of $6,000, so my net obligation becomes negative $1,000. That means negative means I'll get a refund from government of $1,000. It's important point to note. Non-refundable tax credit doesn't make your taxes negative and doesn't lead to tax refunds. Refundable tax credit can lead to tax refunds. So non-refundable tax credit are subtracted from amount of taxes owed but can never reduce the federal tax below zero. And refundable taxes credit are refunded to individual if they qualify, even if the tax liability is zero. So what are tax credit? So basic personal amount. So there is a certain basic personal amount. It's around $11,000 federally that you can claim. Every person can claim. Every person gets the credit for it. Then if you are 65 years or older, you can get certain credits for age. If you have dependent, if you are dependent, you can get certain additional credits. If you are paying certain payments to spouse as for taking care, you can get certain credits. Contributions to CPP that you make and in employment insurance that you make, you can get credit for it. If you have a caregiver for your elderly parents, there are certain credits that you can take. Disability amount, you can take certain credits. Tuition and education expenses and interest on student loans, you can take certain credits. Medical expenses, you can take credit, and charitable donations, you can take credit. So this is an example. Personal amount 11,474, every person can claim. Then spousal credit you can take. Then age amount you can take if your income exceeds age amount. Age credit is 7,125. So if you're 65 years or older, and you can get an additional credit of 7,125, but that reduces when income exceeds 35,000 and eliminated when income exceeds 83,000. Senior, so you can just read through it. This slide indicates how much credit is available and when it gets reduced and when it is eliminated. So continuing, so this education credit has been, government decided to not follow this credit anymore. So since from 2017, the credit on education credit that you were getting as well as textbook credit, they have stopped that, but you still get tax credit for the tuition fees that you pay. But there was certain monthly credit that you used to get if you're studying full time or part time, that you are not getting. And there are certain monthly credit that you used to get if you were spending on textbooks, that is also you don't have from few in the future years. I mentioned that. Now how, if you owe some tax, how do you make those tax payments? So tax payments are first made by your employer. So if you're working in any organization, let's say I'm working with SATE, so each month from my paycheck, SATE deducts certain amount and contributes towards tax. So these are called as payroll deductions or source withholding. Employees who are working with certain employers have to withhold their sources, means they have to deduct taxes and then pay their salary. Employees withhold from sources to pay income tax, CPP and employment insurance contributions, and employers report how much they have withhold in your T4. And if you want, you can reduce your source withholding. So if you think that you're paying too much tax than what is required legally by you, then you can tell your employer to reduce your withholding. Then there are installment payments. If you have taxes that you have to pay more than what is deducted by your employer, so example, if my taxes come to be $12,000 and my employer has withhold taxes worth of $11,000, then $1,000 that I have to pay, I can pay it in installments. Deadlines and penalties: you must file your return by 30th April of each year, otherwise you will start facing a penalty of 5% on the balance that you pay. So three points that are important to note: employers withhold your taxes, means they, before paying you salary, they deduct your taxes, CPP and employment insurance, and give it to government, and you are not responsible for the tax that is withheld. So if employer withholds taxes from you but he doesn't deposit with the government, that is not your fault, so it is considered that you have paid your taxes. Second point: if you have to pay tax that is not covered by source withholding, then you can pay it in installments if that tax is more than $2,000. Third thing, you have to file your tax returns by 30th April. If you don't file, you are charged penalty of 5%. So this is an example of return. You can just go through that. It is there in book also. Then this is continuation of that return. This is how the return looks like. So you can just go through it. Next is tax planning strategies. So what is tax planning? Tax planning is use of legitimate methods to reduce one taxes, and it is different from tax evasion. Tax evasion is use of illegal actions. So tax planning is totally legal. So tax planning is using legal ways to reduce your tax burden. Tax evasion is hiding your income or using illegal ways to reduce taxes. Tax planning is not a crime, tax evasion is a crime. So, what are the tax planning strategies? To maximize after tax cash flows, some simple strategies can be thought of. Are you choosing the right form of remuneration that is most advantageous to you? I'll give you an example. So, if I'm running a small business, I'm owner of a small business, I can take remuneration from that business in two ways. I can either take a fixed salary or I can take dividends. So, whatever profits I am going to generate at the end of the year, I can take dividends on that. Okay. Now, if I don't take salary, so before we'll discuss if I take salary, what happens? If I take salary, so my source of income is salary, I get RRSP deductions, right? I get tax free savings account deductions. Okay, but I would be taxed at my marginal rate. I don't get any deductions that are available for dividend income. If I take remuneration in form of dividends, I do, my salary is not considered for RRSP calculations. So my RRSP, registered retirement savings account contributions, are lower because it depends on salary. But I get certain deductions for dividends. So it is important to structure your remuneration on what you want. If RRSP contributions are important to me, I would rather be considering salary as a remuneration form. If dividends are important for me, I would rather consider dividends. Are you taking full advantage of all deductions and credits that are available for you? So if you're studying in a full-time course, so are you taking deductions of tuition fees that you pay? Are you taking advantage of all possibilities to defer the payment of taxes to a later date? So we'll discuss what is this. But registered retirement savings plan or registered pension plans enable you to pay taxes when you withdraw money. So you get certain tax deductions right now, and you only pay taxes when you withdraw money from those plans. So are you deferring your taxes? This is called as deferment of taxes. So are you deferring your taxes? Should you adopt income splitting techniques? So income splitting is, if my spouse is not earning, so I can split my income with her. Or if I have retired, so I can split my pension with my spouse or with my partner. So how does it work? So am I splitting income? So one form of example is, if I'm if I have a spouse and I'm earning more than my spouse, then in that case I can, means I can run the house, I can have all the expenses that I incur as the house, and all the investments we as a team make it through the lower earning spouse. So all investments are made in the name of lower earning spouse. So so that those investments are taxed at a lower rate than at my rate. So you can split your income, you can split your investments, etc. So, should you adopt income splitting techniques that permit a lower income member of your family to declare investment income and pay less tax while you run the house? Have you organized your investment portfolio so that it attracts the lightest tax liability? So, we'll talk more about it. How should you receive income? If paid commission, you may deduct expenses from your employment. So if you're commission based, so whatever expenses you're incurring for getting those commission, you can deduct those expenses. Some employee benefits receive more favorable tax benefits, like option, if you're getting certain employment options, so you're getting some shares in the company as a part of your remuneration, then those are taxed little beneficially. Take bonus after the year end, so you may decide, means there are certain firms that do not work calendar years, they work in their different ways, and they pay bonuses after the year ends, so you can do that. Tax concern for small business owners, so we have discussed small business owners can either take remuneration or they can take dividend. So how does it work? Now, this is important. One tax planning strategy is to invest in tax free savings account. So, the basic premise is, whatever investments that you make in tax free savings account, all those investments grow tax free. So, you do not have to pay tax on those investments. I'll give you an example. So if I open a tax-free savings account, which I can open very easily with any bank, I can even open it online. Now, in that tax-free savings account, I can make an investment in a debt instrument that pays me interest, or I can buy certain shares in those tax-free savings account, or I can buy a mutual fund. So if I buy a debt instrument, I will be getting paid regular interest. That interest that I am getting paid, I don't have to pay any tax on it. Second, if I buy any shares and the value of those shares grows, so if I buy Apple and I had put it in tax free savings account and it went up from $10 to $100, I don't have to pay tax on the appreciation that I have experienced. Same way, if I have invested in mutual funds and they are growing from $100 to $200, I don't have to pay taxes on it. So investments in tax-free savings account grow tax-free, but there is restriction. You can contribute up to $5,500 annually. Few years back the limit was $10,000. Now they have reduced it to 5,500. So the it started with $5,000, then it went up to 5,500, then it went up to $10,000. Government has again reduced it to $5,500, and it is independent of how much you're contributing towards pension. And unused rooms can be carried forward. So if I don't use entire $5,500 to save, I can carry forward it to next year. Contributions grow tax free, withdrawals are tax free, and withdrawals create contribution rooms for further years. So if I withdraw money, that withdrawn money I can redeposit. Gains and withdrawals are not considered when determining eligibility for federal income tax benefits or credit. Tax-free savings account is subject to the same investment restrictions as RRSP and RSPs. For more information, you can go here. So basic premises: each year government allows you to invest $5,500, and all those investments will grow tax free. You don't have to pay taxes on that. Maximizing the benefit of deductions and tax credit. Be aware of the current tax laws and regulations. Use contributions to retirement plan to defer taxes on income. Maximize your contribution each year. Child support, alimony, spousal maintenance payments are no longer deductible. So in earlier days, if you're paying some child support, you were allowed to take certain deductions in it, but there was a Supreme Court case in the Canadian Supreme Court which said that it is permissible no longer. So how it used to work. So if I am paying $1,000 as child support, then I can take deduction of $1,000, and the person who is getting that child support or spousal support will be that payment will be considered as his or her income. But right now the law has been changed, so I cannot take deductions, and she or the person is not, the income is not considered into account. So recipient, it's not taxed at recipient, and so as a donor also cannot take any deductions. Interest on funds used to earn taxable income is tax deductible. Capital losses incurred should be subtracted from capital gain. This is interesting. So if I am taking a loan to invest, if I have to invest in my retirement plan and I'm taking a loan for that, so whatever interest I pay on that loan, I can take a tax deduction for that. Maximizing the benefits of deductions and tax credit. Be aware of the tax treatment of stock options, capital losses, gains, and lifetime capital gain exemption. So lifetime capital gain exemption is around $800,000. So you can take a exemption of $800,000 on certain classes of assets. All people qualify for basic personal deduction amount and income tax credit. Also can claim for eligible dependents. Interest paid on students loan qualifies as a deduction. Tuition fees and education amounts you have to focus on. Medical expenses incurred, you can get tax deductions for those. And charitable contributions also you can get tax deductions. And charitable contributions, for first $200 you get a tax credit of 15%. So if I'm making charitable contributions up to $200, I get tax credit of 15% on that. And if I'm making tax credit of more than $200, I get 29% tax credit on that. So you have to remember that. Plus you have to restrict you cannot be making more charitable contributions than 75% of your salary for tax purposes. So any charitable contribution that you are making above 75% of your salary will not be considered for tax purposes. Tax deferral techniques. What is deferral? Defer taxation of income until a later date when combined average tax rates will be lower. During deferral period, investment income earned can be reinvested tax free. So registered retirement savings plan, registered pension plans, individual pension plans, deferred profit sharing plans, investing in capital assets, and registered education savings plans are all form of deferral strategies. So what is registered retirement savings plan? So RRSP is a very common thing. You can open it with any banks or any financial institutions. Whatever contribution you make towards RRSPs, you get a tax deduction in your income in that year. So if I'm making a contribution of $1,000 in 2018, I get a deduction of $1,000 in 2018. Point number one. But when I withdraw money from RRSP, I have to pay tax on it. It is not like tax free savings account where when I withdraw I don't have to pay tax. When I withdraw from RRSPs, I have to pay tax. The second point. Third point, you cannot contribute as much as you want. There are certain restrictions. So every year they state a maximum limit of contributions you can make to RRSPs. So let's say in 2017 it was somewhere around $26,000. So you cannot contribute more than that. Second, it is also restricted by amount of salary you earn. You cannot contribute more than 18% of your salaries in RRSPs. Okay. Third, you can withdraw money from RRSPs either for buying a house or for doing education. So two purposes you can take money out of RRSPs, which you again have to contribute back. Registered pension plans, generally you don't open these are opened by your employer. So wherever you're working, mostly they would be having a registered retirement plan. These registered retirement plans are basically two types: defined benefit plan that pay a fixed benefit when you retire, or defined contribution plan. The benefits are not fixed, but the contributions as a percentage are fixed. Individual pension plans. So these, if you are not satisfied by the amount of pension you are going to get from employer, you can additionally open an individual pension plan with an employer only. So if I'm working with SATE and I'm not happy with the pension I'm going to get from SATE, I can open an additional retirement plan with SATE. That is called as individual pension plan. Deferred profit sharing plan. So this is generally for executives. So company can contribute some profits that they have earned into the pension plans for executives, and they are not taxed on it. They have to pay tax only when they withdraw. You can also invest in capital assets and registered education savings plan. Now the important difference is registered retirement savings plan and registered pension plans. You cannot withdraw money from registered pension plans. You can withdraw money for buying a house and for education from RRSPs. So if you have an option between RRSP and registered pension plans, it's far better to go for RRSPs, because at least for certain purposes you can withdraw money. Income splitting technique. It is unlawful to invest in the name of lower income earning spouse or a minor child to have income tax at lower rate. So it's tricky. There are certain legal ways to do it and many other ways are not legal. Okay. And what they do if they find that you are doing that? So there is attribution rule. Attribution rule means income, though a person with lower tax bracket has earned that income, still that income will be attributed to the person of a higher tax bracket. I'll give you an example. So if I'm making an investment in the name of my minor child who is not earning, right, and I get certain returns from those investments, so attribution rule means that return would be counted as my income rather than the income of the child. and it would be taxed at my higher bracket rather than taxing at the lower bracket of the child. So you need to be careful of whatever attribution rules are there. Legal means of income splitting include contribution to spousal RRSPs. You can do that. So if you're earning more than your spouse, then you can contribute to your spouse's RRSPs. Splitting pensions and CPP benefit. Higher income spouse pays living expenses and lower income spouse invests. That is also allowed. Transferring assets used to generate business income. That is also allowed. Opening registered education savings plan, RESPs. That is, this is important. So registered education savings plan you generally open for your kids. The benefit of opening this: first, tax deferral. You are not going to be taxed. Okay, so how does it work? So if your child is born, you start an registered education savings plan and you're depositing $1,000 each year. When he turns 18, he can withdraw that money and use that money for his or her education. Okay. Now, when he withdraws that money, though you have contributed as parents, you are not taxed. He would be taxed. So the tax bracket would be lower, right? Point number one. Point number two, there are certain grants that government gives. So if you're contributing some X amount, government also contributes to that fund some Y amount. This, it is a low amount, but still it contributes. So you can take benefit of it. So it is a very good way to save for your kids' education. Set up interest investment account for minor kids, invest in federal child tax benefit plans, or transfer assets to adult kids. So these are legal ways of splitting your income. You have to also ensure that your portfolio is tax efficient. Interest income fully taxed at marginal tax rate. Dividends and capital gains are taxed less heavily. So interest for loans made for investment purpose are taxed. So 3 points: interest, whatever you get, it is taxed at your full marginal rate, but for capital gains and dividend there are certain deductions that are available. So effectively, if you see, interest are taxed higher than dividends and capital gains. Third thing, if you're taking a loan to invest, the amount of interest that you pay on those loans are tax deductible. Tax issues important to students: learn how to report income from scholarships, fellowship, grants, and RESPs. Get common deductions such as moving expenses, which are also available for education, childcare expenses, interest paid on student loans, non-refundable tax credits such as tuitions and education amounts, other tax credits such as GST, HST, and Canada child tax benefit. Every year, CRA modifies tax returns and filing procedures. Legislation is frequently passed that changes the Income Tax Act. Review changing tax laws when personal financial planning is done. Consider changes in personal situation and income level. So, this is what we have discussed: income deduction, other deduction, tax credit, and other tax credits. You can just read through. Where do you get your information about taxes? Canada Revenue Agency, library and bookstore, internet sites, tax publication, tax preparation softwares and electronic filing, and tax preparation services. These are the major dates. It's much more visible in your book, so just go through your book once. Important point: you have to file your return by 30th April. Tax preparation services. Sources available for professional tax assistance include the following: tax services ranging from local service to national firms. So you, if you don't want to file your tax returns on your own, then you can hire certain people to do it. So there are firms like Liberty Tax that are national level, so they are available in most of the Canadian cities. You can hire an CPA to do it. Tax lawyers generally don't file your tax returns, but if you have any tax disputes, you can hire them. Your returns can be audited. A tax audit is a detailed examination of your returns for Canada Customs and Revenue Agency. So mostly it is a desk audit. So in desk audit, more information is requested. For example, in 2017, I had some global income. So CRA asked me about my global income. So that was done in my audit. Keep detailed records, receipts, cancel checks, evidence to prove amount claim. So you have to maintain all records. It's important. Avoid common filing errors. Okay, one form of very common tax audit. So if you have an house and you're running a business from it. So I'll give you an example. For example, I'm running an Airbnb from my house. Okay. So I can take certain deductions because I'm running a business. Whatever I'm spending on that part of my house that I'm using for business, I can take certain deductions on it. So it depends on the percentage of my house I'm using for business. So home office concept. So CRA may examine your home office. So it may come to your place, see how many rooms you're renting and all those things. Top 10 filing errors, mathematical errors, forgetting, calculating provincial incorrectly, not including pension like RRSP contributions, GST credit incorrectly, claiming incorrect amount of RRSP, forgetting to claim basic income tax amount, etc. So these top errors you have to avoid. Desk audit inquiry mailed to you asking for document. Field audit, they visit you. So two types of audit: desk audit and field audit. Agent visit may request specific information. You can seek guidance from advisor, so you have a right to lawyer. Generally not a cause of alarm. Audit rights, what you have: auditor may only request specific information, he cannot request general information. You can seek guidance. Reassessment cannot go more than 3 years back except in case of fraud. So we have briefly looked at it. In class we'll discuss few case studies on it. Tax planning can influence spending, saving, borrowing. Knowledge of tax law is important. You need to be aware of all tax laws. Major section: filing status, income deductions, tax credit, difference between deductions and tax credit, refund or additional tax you pay, consumer purchasing, use of debt, investments, retirement planning. So how do you get sources? CRA publications, internet, or professional tax services.